the Edward Hutchinson podcast. We are here for another episode, and I'm really happy today to be joined by Tony Svoboda. Is that the right connection?
Yeah, close enough.
Yeah, because I presume you get some issues with that occasionally.
Yeah, my whole life.
Yeah, really. Yeah, I can imagine that because it's the S and the V together.
It throws people off.
Yeah. But anyway, Tony is a loan advisor with RPM Mortgage. I've got that one right because you changed company. You were originally with a bigger few years back.
Well, I was with First Capital Mortgage when I started my career, and then they've changed. Then I was with RPM since 2012.
Yeah.
Then I had a brief stint. I was with MCP for like 6 months, or almost a year actually.
Yeah.
And then I went back to RPM. So I've been with RPM now for another 2 years. So I more or less say it's been since 2012.
Yeah, because it's kind of had a little gap in between.
Yeah.
That's fascinating. Actually, I want to get to chat about that because that's definitely something as an agent that we hear a huge amount about because we get a lot of brokerages constantly contacting us like, oh, come and hang your license with us. And I want to know what that's like.
I can speak somewhat.
Okay, so everyone listening out there, thank you for tuning in. So Tony is obviously more in that mortgage and loan side of the industry, which actually I think is really fascinating because as an agent we get to see certain aspects of it, you know, when we're introducing a client over and we're getting things approved, but it's kind of like we're one step from actually doing that.
Yeah.
So unless we're going through actually getting mortgage refinancing loans ourselves, I feel like we don't actually get that like on the ground experience day to day that you guys get to see, which is really valuable actually market data.
Yeah.
Seeing what things are selling for constantly at scale,
Yeah.
what people are doing, are they refinancing, are they products? But Tony, you've actually been, so you say you've been a mortgage broker here for a while, isn't it? Because I think I looked at your website earlier today, 2001 was the career start.
That's right.
So that's been 18 years.
Yeah.
So does it feel like it's been that long?
I feel like I'm an old timer.
Yeah.
Yeah, no, it definitely, it's very interesting. I think about it, like everything that's been that I've gone through since 2001. I mean, from the beginning, then the rise to the, like when I started in 2001, my first loan I did was a 30-year fixed at 7.25. My very first loan at 7.25, and I think from that point, that was the highest rate. Because shortly after that, the rates just plummeted, and the real estate industry took off, and it was like crazy chaos for 9 years.
Because that was the weird thing. Because I always talk about it. Occasionally, I've spoken to my parents about when they first got their first mortgage, and they talk about it, and they're like, "Yeah, I was paying like 12-13%."
Yeah.
And that was in the 80s, I think, was kind of when they were doing it.
Yeah, it was in the 80s. In the 80s, it was almost 20%, I think. The highest,
which is kind of crazy, and it makes me think that we're in a little bit of like the amount of clients that I talk to now, and they're like, oh, rates have just gone up by like 0.25%.
Yeah. And
then they're like, oh, this is kind of restricting my budget slightly, and I'm a bit like, yeah, but it's not exactly that high in comparison to what any other generation has paid for in mortgages.
No. Yeah, I mean, it's really, rates will fluctuate 1/8, 1/4, 3/8 almost daily, to some extent, but sometimes if it's a big move, it will fluctuate, but it's funny how the public perceives, a rate adjustment of 1/4.
Yeah.
And it sounds like a lot to someone who's not really in it every day like us.
Yeah, and I suppose actually when it's a quarter of a percent, when it's usually like a 4% loan, as opposed to 1/4% when it's a 20%, is quite a big change. Difference.
Yeah, exactly. Yeah.
It's actually like makes it like, okay, wow, it's actually getting it's a lot less budget for what I could have potentially had if I'm spending that.
Yeah.
Which is kind of crazy. Okay, so you got into the industry in 2001, straight away in LA.
Yeah.
Never were kind of working in other markets?
For a minute, I was really green when I started, but I did a few deals in San Diego. I worked for this company, and I was brand new, like hadn't ever, just knew nothing basically. And I was inputting some loans, and I had lived in LA since like 94.
Okay.
So I went to San Diego for about 4 months, and when I was there in San Diego, I just went to work with this company, and that's where I first learned about mortgages. My uncle, who's a real estate, he owns a company in the Midwest, and he said, you really should get into mortgages.
Really?
So I got my real estate license.
Yeah.
Back then, we needed to have a real estate license. And I went to work for a company as just this assistant, I guess. I was just working for a couple of LOs, and I inputted data for them, and then I was looking for a job in LA as a mortgage originator.
Wow.
And I ended up getting one, through a friend. But yeah.
So that's kind of crazy. So you didn't like grow up as a kid thinking I want to be a mortgage broker?
Oh God,
No.
no.
That wasn't the...
No, but I will say that if anything, I thought I was going to be a real estate agent if I was going to do a career.
Really?
Yeah, it wasn't in my, I didn't have aspirations to be a mortgage broker, but my uncle and my family was sort of in the real estate industry since growing up. So I kind of had some exposure to that.
Okay.
Yeah, so if anything, I thought maybe I'd be a real estate agent.
Because that is the weird thing that I kind of think, because all the mortgage brokers I know are actually really great people. They have a great job and they do an incredible thing. But I always think about that because no kid is really generally coming across. Yes, they're like, oh, mum and dad are buying a new house.
Yeah.
But it's not like they're, dealing with the mortgage broker, or it's kind of like a little bit of a hidden, especially from that young generation. So I can't imagine there's a huge amount of kids who are like, I want to be a mortgage broker when they're like 5 years old.
No, I can't imagine either. I think, because it's really not a very glamorous job, like, at least it wasn't back then. I mean, with social media now, it's become, you can get a little bit, if you want, you can put your face out there. But, no, back then it certainly wasn't. Real estate was way more, in front and billboards and, advertising. So nobody knew about the mortgage. In fact, I didn't. When my uncle said you should do mortgages, and I was like, because I kind of had a capacity for numbers.
Yeah.
Although I think I would have done well as a real estate agent even in the beginning, but for some reason I just got into the mortgage side, and
so was that like you were at school, maths and like numbers was kind of where you were most confident?
I'm kind of weird. I have a little bit of both. Like left brain and right brain going on. Yeah. So my dad was an artist.
Yeah.
I don't know if he was good with numbers. He's passed away, but I should ask my family. But so I kind of grew up with my dad on the artist side, creative community.
Yeah.
And then I grew up with my stepdad and my mom. My stepdad was an attorney.
Okay.
So he was a little bit more, on the scholarly thing and
paperwork and sitting down.
And somehow I was in the middle. I went to business school in college and. I got a business degree, and I kind of wanted to be, even back then, I was like, I want to be an actor, which is why I moved to LA originally.
Wow, okay.
Yeah. So, but I had this, I did okay in business school, in college. But I wasn't a math wizard, I wasn't going to MIT. I went to Kansas University.
Okay.
And it's a great college, but and it was a lot of fun. But I don't know where I'm going with this, but when I got into the real estate industry, I figured, I wanted my weekends, which is kind of why I started to lean towards the mortgage. Yeah. And my uncle said, you should try mortgages. I think you'd be good at it. And I think he just knew me personally, kind of what my capacity was. And one thing led to another, and I was doing loans from the beginning. That is really
interesting.
Yeah.
So, because that's a huge amount of the people that I kind of come across is, a lot of people move to LA, and especially I suppose at that time, because it was like movie industry, you want to be an actor. Yeah. If you want to be an actor, this is the kind of the place to be.
Absolutely.
And there's a lot of people that I see who come here, like try and make a career after a couple of years, and they kind of either move back to where they came from, or they're kind of doing a side job and then doing a bit of acting kind of thing. Yeah, like absolutely. Working in a restaurant or whatever it is, and then trying to put their like 9 to 5 day kind of schedule.
Yeah, what's interesting is that when I first started doing mortgages, so I got this job in LA. Yeah. And I honestly, in looking back, I knew nothing. So, but they put me into this real estate office on Sunset Strip. I mean, of like this kid, I've been in LA for a while, but I was still from Kansas, a little bit green, and I really didn't know what I was doing. But I got thrown into this real estate office, and back then it was busy, it was chaotic, and it was just like get it done, and that's when you could get things done with loans pretty, not like it is today without all the regulations.
So but just get them through fast and sign them out. And it's
yeah, absolutely. Okay. And but I was battling with what what I wanted to do for a career. Yeah. Like I didn't think I would be a mortgage broker. I didn't move out to LA to be a mortgage broker. Yeah. But I just kept working. I was just showing up every day and working. And I kept getting more business, and I was doing better. And as I got more successful, and I mean even a short amount of time, let's say 2-year period. Yeah. I say this with humility, but almost every paycheck I got for every 2 weeks, it was like a record. Like,
Really?
I mean, my paychecks kept getting higher and higher,
So, like,
and more
motivation
and
of-
more, and I kept looking at them like, oh my God, like this is like the best month I've ever had, or the
Yeah.
best paycheck I've ever had, and I was seeing big numbers, and as I started to see these big numbers, I was like, why would I even want to do anything else right now? So I just
Yeah.
surrendered, and when I surrendered to being a mortgage broker, I said, okay, I'm a mortgage broker. That's
You
my
went all in on
career,
it.
and I went all in, and it just took off.
Really?
Yeah, like I from that point on, I did so well. I was very successful, and
So if there's someone out there who's listening who's like, you know what, actually they find themselves in a similar situation where maybe they're, you know, looking at the mortgage industry and they're like, actually, I think I could see myself doing that.
Mhm.
Is there anything where you would kind of turn around and be like, this is kind of what was like what you focused on, which you found in your early days brought you a lot of success? Because it is a lot of socializing and kind of picking up new realtors, and because obviously they have clients who are going to need your products, and
Yeah.
was there anything there that like really was kind of your key?
I was really fortunate back then because I was in a real estate office, which it made it didn't make it easier, but it did provide me an opportunity to be in front of all the agents.
Yeah.
So I learned how to work it from that angle.
Like the FaceTime kind of.
Yeah.
Yeah.
Exactly. And I kind of learned how to, you know, under promise and over deliver. But the thing is, I would say is really getting, I became obsessed with learning the industry.
Yeah.
Because I was there face to face. I mean, I was in the room.
And they're going to be
And,
asking you.
yeah,
probably,
and so if I didn't know what, like,
Yeah.
you know, what this program was about, or if this person can qualify. So, I mean, I think that was when I surrendered to is when I really started to study. You know, I studied a lot, and I wanted to understand how everything worked.
And so was that a time, 2001, were there computers? Because computers were around.
Yeah.
But were they being used in the industry kind of regularly by everyone at that point?
Yeah. I mean, although, you know, it was different in the sense, like, I don't know what social media was around back then, but I don't think there was any.
Nothing really,
it was just, you know, like emails and whatnot.
Yeah, because I think Facebook was probably 2006, 2007.
Yeah.
And that was kind of the first big one, I think, where
Yeah.
everyone was like, what is this?
Yeah.
Maybe MySpace was
MySpace,
like
yeah,
around
yeah.
or something, maybe, yeah. So that's crazy. So when you were back then, though, you literally, if you were checking what rates were doing, everything like that, it was on a computer screen. You were tuning in to kind of see what the banks were doing, and that's how you would keep on top of the market and the rates?
Well, actually, yeah, we probably would get emailed rate sheets.
Okay.
And back then, it's a pretty, even today, it's actually kind of chaotic in the sense that every lender has a rate sheet and a matrix.
Okay,
and we'd
yeah.
get the rate sheet and the matrix, and so I'd have to study how to read a rate sheet, but how to quote a rate.
Yeah.
Because it would be the worst is to misquote something.
Yeah.
On either high or low, because it can come back to bite you. And then the matrix. So the matrix is like this one page or 2 page, you know, if this then that. You kind of just gotta follow it along to see how someone might qualify,
Yeah.
and then maybe call the loan rep and run the scenario
Just
by them.
verify it and
yeah.
make sure.
So back then, and we would just get these rate sheets, and had to go through and just know.
Work it out in your own brain.
Every lender, every investor has different rates and programs and,
Yeah.
and things. So that's where a lot of it came. You know, like a lot of the studying, and then it was always changing. There was new lenders coming to the table, like seemed like every other month.
And so was there ever a point where you were kind of like, you wanted to go and work for just one bank in-house kind of program?
Thought about it.
You did?
Yeah, and that's a great question because it's always been something to consider, but for whatever reason, I just landed at a company that was a brokerage, and so that's why I always say, like, I was raised in a real estate office as a mortgage broker, I didn't work for a big bank, so all I really know is that. But I understand big banks, I know how they work, but I just grew up with. I liked having the ability to broker out. I liked having the ability to do a lot.
Yeah.
And most of my loans I can do, you know, like from the beginning, paper, straightforward, big bank loans, but I can also do the quirky, alt-A things.
You've got a client in a weird situation, you need to kind of find a way to get them the loan.
Yeah,
which
and
isn't
that
box.
that gets me excited.
Yeah.
Like, I'd rather do that than work at a big bank and do one
Yeah.
streamline of transactions or one loan programs.
Because that's always the thing with me. Because we obviously deal with brokers from the kind of big banks. Bank of America, they've got their own guys that do their in-house stuff, and then mortgage brokers who are independent, who are arranging loans with all the banks. And obviously there are some amazing banks out there that have great products, but it's never, I find, that one bank's got all the great products that do the entire market.
That's right.
So I think if I was a mortgage broker and I worked for one of the banks, I'd be like tearing my hair out a little bit, because yes, if you have that one client who fits all that parameters, this is perfect. You are going to have the best loan, and that's great.
Yeah.
But equally, I mean, you kind of got this thing over your head which stops you from doing anything but the products that they're actually putting out there.
Yeah.
I think I'd go a bit mental.
Yeah, I mean, I definitely enjoy. Again, I enjoy I get a lot of excitement out of someone who comes in and it's a challenging situation.
Mm-hmm.
And there are no loans are equal. I mean, and it's almost impossible to take a rate off a shelf and just say this is the rate, because it's really much more complicated than that. But yeah, so I really liked having the idea of being able to offer a wide variety of programs to the clients, and it was absolutely necessary to be working in a real estate office to have access to a variety of programs.
Okay.
Yeah.
So is there? So originally, then you're not from LA, Tony. You're from Kansas, is what we just said, because you just got back from there.
Kansas City, yeah.
So was that kind of, you were raised in Kansas and you kind of were like, I want to go and live in the. Because Kansas City's still the main city.
Yeah.
It's maybe not quite LA size scale.
It's not, but yeah, it's a city. Even growing up, I felt it was a big city, but the reality when I moved to LA, I realized Kansas City is still a small, big city.
Yeah.
It's a Midwestern city, but it's a great place to grow up.
Yeah, definitely. And so do you head back there quite regularly? Because you got family
I try to go
there.
once or twice a year.
Okay.
Yeah. Probably my family would love to see me more, but yeah, I do have a lot of friends and family there, yeah.
And so when you kind of got to, when was it, 1994 you said you moved? You were like, okay, I'm out of here, I'm going to be an actor in LA, just moved straight here, and never looked back and thought, actually, you know what, I want to raise a family back where I came from?
Pretty much. It's funny because I got this great job when I was in Kansas City. I was a big avid golfer. I grew up playing a lot of golf.
Oh, really? Still play?
Some. I haven't played in a while, but I like to play, and I was pretty good back then too. But I got a job working for TaylorMade Golf.
Okay.
And this was out of Kansas City. And back then, TaylorMade was huge.
Everything.
Callaway and TaylorMade were like the two biggest companies. It's a dream job. I mean, honestly, it was an absolute dream job for anyone. And I was
Especially
a young
if you're
kid.
a big golfer and you love it.
Absolutely.
Yeah.
And so the point is that after about a year or so of doing that job, I had such a strong desire to come to LA.
Yeah.
And I couldn't shake it, And so
is that because you'd visited it and you were kind of, this is where I want to be?
A little bit.
Okay.
Yeah, and I did come visit once or twice before I actually moved.
Okay.
I had a couple of friends here, and that's an age where you're still coming of age. It's an age where you're still there's so much ahead of.
Yeah.
There was so much ahead of me, and I wanted to see the world, and I wanted to get out, and I had this little bit of a fear that I would be, I would spend the rest of my life in Kansas City working this job because it was such a great job.
Yeah.
And it's weird to say, but it was so good that I thought I might not ever leave unless I get transferred or something.
That's fascinating, yeah.
So I just took a chance. It's a big risk, and I'm kind of like that. But I just said I've got to go.
Yeah.
To
Otherwise,
LA.
you're going to regret it probably.
That's absolutely. So so it was kind of crazy, but I quit that job and moved to LA to be an actor, to be an actor and not have a career. It was really bizarre.
Yeah, that is. And were there any other kids that you grew up with who did the same kind of thing?
Not a lot.
Really?
No.
Because actually, my wife's family, they're all like Chicago, but she's definitely got a lot of like her friends who lived in the surrounding areas and that kind of thing. And a lot of them, when they were younger, always talked about, oh, well, I'm going to move to New York or LA or whatever it was. But there's a huge amount of them who now I talk to them and they're like, I love Chicago, I'm going to live here forever.
Yeah.
But it was kind of when I first met them, it was like, I'm going to go and do this. And then it was almost like they found themselves comfortable in their same spot. And I don't know if they will regret it necessarily, some of those people. Because America's so big in that way.
Yeah.
And you've got that whole central zone. It does become...
Yeah, I think that my friends who I just saw recently.
Yeah.
You know, I think for the most part they're all very happy
Yeah.
and they have great lives. You know, and it's kind of fun to go back and see. You know, their kids are. I mean, their kids are in college. You know, some of them.
Yeah.
And you know, I probably would have a kid in college had I stayed. And I, you know,
have
kinda,
the kids young and you
I
raise
look back.
them. And,
I look and I think this could have been me.
Right.
You know. Maybe I might have been 20 pounds heavier. I don't know, but I could have had a couple kids.
The accent probably a bit more Kansas.
Yeah.
Yeah.
But so I look back and I think I'll look at that all the time. You know,
Yeah.
but they're all happy and they stayed and that's what they wanted.
Yeah.
You know,
Which is kind of awesome.
yeah.
Okay, so maybe let's move a little bit, Tony, onto like mortgages, the rates, because we started talking about kind of obviously back, you know, when you first started, rates were a lot higher. We obviously, I think, have had like, it seems like since I've been working in real estate, which has been 2012, that it's kind of just been a constant, small ebbs and flows,
Yeah.
but it's been affordable in comparison to like looking back at history.
Yeah.
Do you look at the market and you're like, wow, we're just over lending and we're giving people almost too much money, and we're going to kind of have a situation like we did in like the 2009 situation where, because I remember, because I was working just kind of after that period in London, and London is a bit of a weird one where it's, because it is like the one major city in the UK, there's obviously a lot of other big cities, but it's not like LA and New York and Chicago and like all these, London's London.
Yeah.
And so I think we lost like 10% on prices in 2009 and they went back up 10% in 2010. So it was almost like we had a little hiccup. But then I was looking at some of the mortgage products there where they were giving people like 100%.
Yeah.
And not at ridiculous rates. It was
Right.
quite a competitive rate. And obviously watching, like, you know, with hindsight and looking back on it, I'm a bit like, how did anyone ever think that this was going to be affordable to the masses?
Yeah.
Do you ever worry that we're doing that but not going to the extreme of that like 100% loan kind of situation?
Well, I can speak, you know, I do follow some on a national level, but, you know, when I think about most of my day-to-day business is obviously in Los Angeles, and I don't worry about it too much. I mean, I think that there are talks of recession coming, and there are talks of rates remaining low up through 2020 and through 2020. But the lending guidelines have become so rigorous,
And they still are.
and they for the most part, you know, there is money coming to the table that is a little bit more, that's a little less stringent, a little less more. They offer some opportunities for buyers to come in. But I do think it's responsible underwriting, and like there's an ability to repay on a lot of primary residence loans, and an ability to show ability to repay. I think we didn't have that much before this all started.
Yeah.
And I think that there are also still a lot of homeowners with untapped equity
Yeah.
that they haven't been able to get yet.
Definitely.
And there's sort of waiting in the sidelines.
Especially like my parents' generation and older, I find.
Yeah.
It's kind of like they bought their house 25, 30 years ago, and actually what they bought it for compared to what the market value of it right now is just dramatically different.
Yeah. And if you in LA, you know, we have a lot of self-employed freelance people in the industry, and unless they have the documentation to show that they can qualify for a loan by the lender's guidelines, you know, not their own, but by the lenders, that's where it's become. They just can't refinance, or they can't access equity to pay down debt or whatever, and that's money that's not getting into the system, which I think would be helpful, and you know, as a whole. Yeah. But I don't, you know, there are even lenders who will do, you know, 97% financing. There's FHA who does, you know, that can do 96.5. Yeah. And some cases there are loans available with zero down. Really? But they, you know, in certain areas or up to certain limits. But I honestly, most of my, almost all of my deals are at, you know, 10, 20, at least 20% down. Yeah. My average loan size is about 700,000. Okay. And at that level, there aren't a lot of zero down or very low down, but it does exist. Yeah. I mean, and I actually, I just did a deal it's a $3.3 million sales price at 15% down. Okay. Which is really low. Yeah. But and the borrower happened to have a BK actually less than 4 years, seasons less than 4 years.
Wow.
So it's a pretty good loan, but they needed to prove the income to get the loan, and so it's a risky loan, but not as risky as it was before, where they wouldn't even need to document the income.
Yeah. Was there moments in that kind of 2008, 2009 kind of crash, or the lead up to it probably, where you were kind of doing mortgages for people or seeing other mortgages that were being taken out and being like, this is crazy?
Yeah. Absolutely, yeah. There were, our company the First Capital was great. We would have meetings and, be like, just be responsible. Like,
Really?
these loans could come back and bite the borrower. So explain that, if they choose to get this loan. But I remember thinking, I would see it's kind of a trickle down. I mean, the thing is, like, there's an investor in Wall Street who wants access to mortgages. So they hit up, a level, and then that level looks at us and says, okay, here's the program that we want to offer. And then they send me a flyer, and I look at it, and it's like a 0 down loan up to 1.4 million. And I just was like, I can't believe this is available. Like we're really pushing the limits.
But then the economy has been great for quite a few years, and you're like, wow, this is the future almost of what is possible. Yeah.
And so, and I remember thinking, well, someone must know something I don't. I mean, because it's not my money I'm lending. It's a huge some institution on Wall Street.
Yeah.
Now they're presenting this product.
Big name on the actual thing.
Yeah. So that happened a lot. I was like, but eventually it stopped. It stopped abruptly. But
so did you have any clients after that who had to foreclose and kind of lost their property?
I mean, I didn't. I don't get notice.
Yeah.
But yes, there were. I know for sure that clients had gotten into trouble and they had to sell or they got foreclosure, or they walked away. But that was quite common all over LA.
Yeah.
It was just, but the foreclosure filings started to really skyrocket around that time, and homeowners just felt it easier to walk away.
Really, they're just like I'm gonna
just
lose
walk. Yeah, not
that.
even try to get the money to. They just walked away from the home.
Really,
and that's what was scary, because when someone. But I think that's what is slightly different now. I mean, so they're not the lending guidelines. They're not lending to. I mean, it's hard to say on a blanket level, but they're not really lending to those individuals who might be more inclined to walk away if they get into trouble.
Okay.
And I think that to some extent I'll give credit to the risk and the guidelines that they have put together so that they can underwrite responsibly.
Yeah.
And those homeowners are probably less inclined to walk away. Yeah. Especially if they have equity in the game. Yeah. And that's the key.
And then that's why we're seeing 10%. Whenever I'm talking to a client, they're like, what someone who's not actually really looking to buy. They're like, oh, if I wanted to buy a house in the next couple of years, that just conversation with your friends. Yeah. What do I need to put down on a property? And I'm like, 10% really is kind of the minimum of what you really should look at.
I think, and I think, even if they could put 5% or 3% down, it's possible. And sometimes, trust me, if it's, I love talking to potential homeowners about this because I like getting a gauge of what their game plan is, what they want to do if they haven't starting a family or whatever it may be.
They're going to live in it,
because sometimes a 3% down. Also, you got to make look at their portfolio and say look, you don't want to use every penny you have for a down payment. Yeah. You need some to save, and so sometimes it makes sense.
And,
So I like that process, but 10% and 10% will give you decent programs and rates. 20% you'll get much better terms. So the less you put down, the worse the terms are in general. But
and higher, and you're going to be in a bit of a situation where your overheads are significantly more because you're paying more on a bigger loan basically.
And there's like mortgage insurance or FHA has upfront MIP, so things like that can get costly. And there are fees that you might be able to avoid by putting a little bit more down. So the sweet spot is 20%, but 10% is
minimum,
like
kind of.
It's a good starting point.
Okay. Mm-hmm. Okay, so do you think that there's any worry that it is going to go back that way over the next like 20, 30 years? Because it does seem a little bit like when it first happened, 2009 situation, all the banks were like, no, we're going really strict and we're going to shut all of this down. Boom, we're only going to give you this. You have to tick all of these boxes to get it. And it feels like, fast forward 10 years, it has started to seed slowly. They're like, okay, maybe we'll do this, maybe we'll do that.
Yeah.
What I worry about is because sometimes I look at like history, I love looking back at like how we kind of seem to repeat the same things over and over again as society. And I worry that in like 30 years, the generations below us are going to be like, oh, what do you mean? It's fine.
Yeah.
And we're going to go through another situation like that. Do you think that could happen? Or you think actually because it's been documented, it's out there, it's kind of known what happened in that situation, that it's going to be hard for us to go and...
I feel like if I had a crystal ball, I do think that more money will come to the table for buyers to purchase something with very little down.
Yeah. Okay.
More so than it is today. Because I think there are going to be investors out there who will want that business.
Yeah, because it's solid, isn't it? Like you're kind of...
It's a niche, and not they might come to the table and offer something that no one's doing.
Yeah.
Because right now it's just not widely accepted. Although little down up to 2 and 3 million is possible. Like I said, there's 10%, 15% down at these levels.
Yeah.
Which is pretty high. That's a pretty low down for those sales prices.
Definitely.
So yeah, in 30 years, I don't know.
Knows? Yeah.
I think that we're smarter as a lending culture now.
Yeah.
And I think if they were to mismanage like the borrower's ability to repay, then that's the real trouble.
Yeah.
But if they can provide some responsible underwriting and look at a potential buyer and determine the credit risk, their credit history, their income, their employment, things that they didn't really look at before when they were just throwing money to anyone. If they look at those things, it's less risk, and generally I think that the homeowner would be less likely to walk away, which is where the real problem starts to get, and they default. As soon as they default and they get a couple months behind, they just turn their back, and it's down. The bank owns this property. It's a problem. Yeah. But so I feel like that we'll be smarter as a lending culture. That they'll be like, okay, we'll analyze this a little bit better.
Because that's what I'm hearing. Like, I don't know if you've heard this because you're probably more in that kind of financial sector, but I'm hearing big rumours that we're going to have the next economic downturn, and it's actually not going to be obviously due to mortgages and the lending on this side, but it's actually going to be sparked by student loan debt.
Yeah.
Because it's kind of a weird situation where a huge amount, it's almost the same kind of thing, but obviously in a completely different way, where all of these companies are throwing money at young people and saying, oh, go to this college, get this degree, and therefore you're going to have a salary of this so you can repay this back. Yeah. And it has become a bit of a weird situation where I think absolutely the top universities in the country and in the world are going to get you a good position. There's a huge amount of people who now leave university with a degree of this from that university, and it is not giving them the entrance to a job that's going to allow them the money to pay down that debt.
Yeah. There's probably going to be a lot of student loan debt forgiven or in default.
Yeah, because that's the weird thing, because I think it's the only debt, or one of the only debts you can't declare bankruptcy against. Right. Which is weird.
Yeah, and I think that there will probably be regulations to combat that too. Yeah. Because we always, it's just like the housing industry and probably credit card debt and student loan debt. It's like the pendulum swings back and forth, and it's impossible to ever get it just right.
Yeah, in the middle zone where actually it's good for everyone. But that's the weird thing, because a lot of other people that I was speaking to about the 2009 situation were kind of saying we almost put like a Band-Aid on it by bailing out the banks and not saying, right, well, you made a mistake, therefore we're in a capitalist environment, therefore you fail. Mm-hmm. Instead of that, they kind of said, oh, well, we can't allow this to happen. Right. But that's where I worry slightly the next one's going to be way worse almost. Because
it's tough. And I would love to read a case study on what, I'm sure there's something like, what if we did just let it fail? Yeah. Like, what's the hypothesis that what would have happened? Because we don't know. But I wonder. Yeah.
Because I almost think that, like, it would have been a much worse, like, that couple of years after it.
Yeah.
But right now we'd be in a better position almost.
Possibly.
Yeah.
Yeah.
This is almost like that short-term, long-term
Possibly.
kind of thing.
That I kind of feel the same.
Yeah.
Yeah. I mean, I think it would have been a pretty devastating blow for about 12 months or so.
Yeah.
You know, but I remember when the crash first started, I think it was so crazy that lenders weren't even taking locks. Like there was a couple of days or a week where lenders shut down. Like, we just got to figure out what is happening.
What were you telling that to clients?
We were just like, we were all like, as mortgage brokers, I think we were all like deer in headlights. You know, we were just stunned. And
emailing your client saying, I don't know what's going on.
Yeah, I'm like getting my resume together. Like, I didn't know what,
Yeah.
But so it's interesting to find out what could have happened.
Yeah.
But I do think it would have been I think that would have happened on a drastic level.
Yeah.
For a longer amount of time. Lenders would have been completely shut down.
Yeah.
For a while. And that's why when they stepped in, they prevented that from happening.
What would happen in that situation, do you think? Because I don't think we've ever really seen it, obviously not at scale, but if a bank that has given someone a loan for a property, and a lot of these banks are massive multi-billion-dollar kind of entities, that entity becomes, liquidated and is no longer... What happens to the loan agreement with that owner? Is it suddenly like they're just handed the property?
Well, you mean if the bank
goes out of business, if they're not bailed out by the government and they're just like, look, we've got no money, we're closing our doors tomorrow, everyone's fired. What happens then to that money that's kind of been loaned out to those individuals?
That I don't know.
Yeah,
That'd be a good question for a real estate attorney, but I'm sure the homeowner would have. They would lean towards the homeowner.
Yeah, or they'd like
scenario.
say, can you just reduce the debt or something like that?
Yeah, and that actually happened that was also, the loan modifications were very prevalent after all that.
Okay.
Probably in an effort to keep the homeowner or to keep the house.
Yeah, they reduced the rates on certain ones because they were like, look, we don't want you just to not pay us. We'd rather take a little bit less profit on this and make sure that we're not losing.
It happened. That was, they would reduce rates as low as 1 or 2%, and even put the property tax delinquencies on the back end of the loan so that the homeowner could literally just get their payment to a manageable level.
Okay, yeah, so that's going to be a fascinating one.
Yeah.
Because I think that's going to be a really interesting play. What do you think about... So we've also been playing around the idea a lot, because obviously, like, I'm very into technology in the future, and we've had these discussions, I think, where I'm kind of like, where I see our industry going. I felt recently a really interesting one was the Facebook announcement of their new cryptocurrency. Did you see that?
No.
Okay, so they basically said that they're now going to create their own kind of Bitcoin or crypto, and it's going to be available on Facebook for people to trade things.
Okay.
And that's where it's a weird one, because I think governments are going to stop crypto from becoming the US dollar or whatever that's going to be, because obviously they lose a massive amount of control.
Absolutely.
But equally, I think fast forward, I don't know how long, maybe 100 years or something like that, using crypto to purchase a property actually has a massive amount of benefits. Because you actually don't have to be like, where's the funds? You're transferring it to that person's account. It's all like documented within the process. Yeah. And so that's a weird one where I look at like my job and I'm like, okay, well if some owner wants to sell their house, they could literally set like a crypto, this is what I want to get for it. Mm-hmm. Because we now have smartphones, take pictures or whatever, 3D map a property, put it online. And effectively, someone can transfer that money, and it's almost its own contract in that. So me doing like the negotiation level, yes, until technology somehow kind of takes that on. But do you think, is there ever any kind of whispers or anything like that in the mortgage industry where people are like, oh, crypto and, how people actually trade?
The only thing that I've seen is that the lenders will accept money sourced from crypto.
Okay.
But they won't
take
the crypto. But so that's a pretty giant step for the mortgage industry, that they'll use funds like sourced from crypto.
Yeah.
But I haven't seen or heard anything about like actual cryptocurrency in loans, and I'm sure that it wouldn't be widespread.
No.
Most
like
of these
one
institutions who are lending money, that's all they've done.
Yeah.
So it would have to be this cutting edge financial, fintech type of a thing.
Yeah.
With coming to the table, which I do think is possible.
Yeah.
And I could see it happening. I mean, have you seen transactions like homes bought using crypto?
We've seen you get and I think at the moment, because it's still very early days, but I think we've seen the ones where realtors will list a property and they say, oh, Bitcoin will be accepted.
Okay.
And it was a bit more, I think, when was it, like 18 months ago, when Bitcoin and crypto was all over the press everywhere, and it had soared up to like $19,000 a Bitcoin, where I think that was kind of, they were playing off that environment where obviously there was a huge amount of like probably tech guys who'd bought some Bitcoin, 10 years ago, and then had been like, oh my God, I've got this all sitting in an account right now, maybe I could just buy a house with it. Yeah. And so I think they were going after that a little bit, but I definitely haven't seen, what I found quite interesting is actually like, I think it could affect our international market quite well, or not well, but in a very weird way. Yeah. Because at the moment, I know that LA had a huge amount of Chinese buyers that were buying property here kind of 5 years ago. Yeah. And it was when China is kind of doing well, and a lot of these Chinese families and businesses were making insane money. Yeah. They're like, oh, I'm going to buy a place in LA. So a lot of the high-priced properties were going to those kinds of buyers. Yeah. I think the Chinese government then put in a restriction saying every Chinese individual cannot take more than $50,000 out of China every year. So we had some creative ones, I think, where it was like families of 25 all like putting their 50 grand together and doing it. Yeah. But if that goes into a crypto world, you can't control.
It's not regulated. So
basically it's like, oh, if that person makes crypto in that country, they could literally just transfer it to someone else's account in exchange for that property. Yeah. So it almost seems to me like, again, it could take 100 years to get to that point, but there's going to be a lot of like change.
I feel like that will happen, and probably, based on what we know about how fast technology goes, it won't be 100 years. It'll happen a lot sooner. Yeah. I'm sure you'll be by the time you're done with your career, you will have done many crypto deals. Hopefully. Yeah. But I think it would definitely make things easier. And I also saw like. I watched your podcast with the Colossal.
With Philip Braunstein.
Yeah, with Phil. I thought that was great. And, they brought up a good point, like the next couple of years will help really determine, how the upper high-end, $50 million, $100 million, $200 million properties will sell, and how that will do. And LA could be the market for that. Yeah. And I think if it's going to use foreign money, I think there might be some creative solutions to get that foreign money into, to buying property here.
Definitely. Especially now, as it feels like community through the internet across the world is just so much more interlinked.
Absolutely.
So you can do business with anyone across the world ever. So yeah, that person buying that 50 million could be from anywhere in the world. It's not like, oh, well, I grew up in LA, this is my neighborhood, therefore I want the property here.
And as sellers become more savvy, the buyers, like as buyers and sellers become more savvy, and I think they'll be willing to take crypto or other currencies, and I think that's probably going to happen sooner than later.
Yeah, I think you're right. That's where I see it, because I think the weird thing is, I think also technology though advances at this insanely, like it's accelerating how fast it's coming out. Yeah. However, society, like human beings, like things the way they know them. And they're not always open to like testing something out with change. Right. And so it's almost like the technology's going there, and it kind of drags human beings almost along behind it. Yeah. Which is quite fascinating, because I can imagine the amount of restrictions that are going to be like put in on that at some stage, and probably really slowly. Yeah. Yeah. Just because of there's also protection of like. Anyway, we're getting into some deep crypto stuff here. Maybe we should do that on a separate like podcast thing. But that actually pinged in my head. So with those kind of high-priced properties, and we've seen some insane ones, especially maybe not compared to New York and some other major cities, but LA didn't have the biggest sales prices around in the US. And we have actually, over the last like 5 years, it seems, seen a massive amount of these ones being built that are like 100 mil plus. We had one that hit the market at 250 million. We've got one that's apparently under construction right now at 500 million in Bel Air. When you're dealing with mortgages, do you ever see those deals?
No.
What? Because I presume those people are buying cash.
Or cash, or they're getting money from private resources or private banks.
Okay.
But because I do get looks at loans that possibly can go as high as 7-10 million.
Okay.
But most of the lenders that that I work with are that they're 100 to 10 million or 20 million. We just don't see a lot of those. But I will say that I have a few investors who will probably entertain anything because it's on those loans. It's a lot of it's going to be 50%.
Yeah.
50% loan to value or even less.
Yeah.
And with that kind of equity in the game, they might have resources for that kind of money.
Yeah.
But generally, the private investors who are doing loans on things of that nature, cross loans, bridge loans, no documentation loans for investment properties, things like that. They're not really. They don't have a fund that can handle
that
a
size.
That size.
Yeah, because that's all their kind of equity
Exactly.
into one deal,
Yeah,
which is massive risk.
Yeah.
Yeah, because that is quite an interesting trend. I think that you see the people that buy the most expensive tend to buy them cash.
Right.
And then the people that are buying the cheapest stuff buys it with a loan. And it kind of makes me think, obviously you need to have a huge amount of cash to do that. But what about refinancing? Do you see that side of it at all ever? Where someone buys a $20 million house cash and then a couple of years later is like, oh, I want to liquidate some of the equity out of that. And then we'll refinance a couple of million.
Sometimes.
Yeah.
Yeah.
But it's never where they're kind of taking out a majority almost against.
Yeah. No, that doesn't.
Loan value.
That doesn't really happen often. No.
Okay. Yeah, because that's where I look at it. Because I sometimes go over these properties. I'm like, for 500 million. When you're buying a property for 500 million, which in itself is an insane amount of money.
Yeah.
Then you're paying like 1.25% property tax every year.
Yeah.
Which is going to be absolutely 5.5
Crazy.
million.
Yeah.
Plus. And then you're obviously having to maintain it. You're having to it is actually insane, kind of what that can be.
Yeah. Well, those guys, those homeowners have family offices, and they're just they probably have money they could margin and borrow off of, so it's just a whole different lending strategy.
Yeah, it's actually interesting. I don't know if you saw the podcast I did with Jesse Harrison Design. He actually said he builds homes for quite a few high-profile family clients in Holmby Hills and those kinds of areas. And he said quite a few of them design the property, build it out, and then they literally are turning around to him 3 years later and they're like, I'm just throwing money into a pit here. Because it's almost like they have their area of the property and they have their people that work for them's quarters. And then they're having to they're barely using it. Yeah. That is another thing I find, which is quite hilarious.
Yeah,
they're there for 2 weeks a year.
Yeah.
And then they're coming back and they're like, oh, now we've got an issue with the roof or whatever it is, and it just seems to be constant.
Yeah.
That they're kind of doing that thing. So I'm always wondering, how does that play out? Because it does seem that we've got a bit of a gluttony of those highly priced properties in the market right now. Yeah. But I have heard actually also that there's been quite a few high price purchases over the last 6 months.
Yeah.
So we'll see if that's maybe some indication of.
Yeah.
That's fascinating. Because actually, the big one I really noticed in the press was, I can't remember the guy's name off the top of my head, Chicago, and he bought the most expensive one in New York, 240 million, I think it was. And then he also, 3 days earlier, bought the most expensive one in London, which was £98 million.
Wow. And
so I was looking at him, and I'm like, okay, this guy's got some serious financial knowledge in his head because he runs a VC firm.
Yeah.
And I think he's worth 14 billion. So what is he seeing in the economy where he's looking at two big trophy assets and putting his money into them?
Yeah, I question that too. Yeah. Because who's going to buy that?
Yeah.
Maybe there are that level out there.
Yeah.
But I suppose it's a good place for him to put the money. Yeah. For strategic reasons.
Yeah, and then I suppose he could liquidate it and still hold the assets there. Yeah. But yeah, it does. To me, I'm like, what am I not seeing here?
But maybe he knows something, and there will be buyers that come to the table, and if he does want to sell in 10 years, or maybe he doesn't have a plan to sell. But
on that, and obviously, I want everyone listening out there to realize that this is completely personal and only based on your kind of knowledge, and you can't predict the future. But do you think that right now is a good time to buy in LA?
Well, for sure, from an interest rate standpoint.
Yeah.
Because if you buy, let's say the rates are probably going to hold steady for the next year.
Yeah.
Okay, or year and a half.
Okay.
with some, variance, plus or minus a quarter or maybe. But if the property values go up 4%,
Yeah. 3%
or 4% in that year,
yeah,
now would be a good time to buy.
definitely.
So I think it makes sense. But historically speaking, rates are, again, they're still at the very lows.
Very best they've been.
Absolutely.
Because I do have a lot of clients who turn around to me, and it's actually become less than it probably was 8 months ago, where they're kind of saying, look, I see, the market's been so strong for like the last 10 years.
Yeah.
And so therefore, we're going to have a crash at some point.
Yeah.
And so I think it's because of the time frame. In their heads, they're like, oh, well, there's some economic turmoil every 10 years kind of thing, so we're owed one.
Well, my theory on that is there's always been a buyer in every market.
Yeah.
And there's every single market, it doesn't matter. But if you just are a savvy buyer, if you're buying the most expensive house on the block, you might not have a lot of room to grow unless that's a developing street and they're building redoing a lot of properties on that street, and they're going to be more expensive.
Yeah.
If you're hip to that knowledge, it might be a sane investment. Where even if there's a market crash, you're kind of protected a little bit.
Yeah.
But LA, LA is a monster,
Yeah.
and there's so many different areas and pockets that have so much potential.
100%.
So that's what I think. If you're a buyer and you do some homework and you're savvy and you understand the neighborhood and the what's happening in the neighborhood and the street, if you can see, it makes even.
It's almost like look at it at the micro and find the good deal. Don't look at it like macro.
Yeah.
Oh, we're gonna.
Yeah, because it's a little different, and even during the crash, people were buying and selling in these areas, and I'm grateful. Most of my transactions are done from like the ocean to downtown, but within that, there are a lot of great areas. Hancock Park and Beverly Hills. They were, through the recession, through the crash, people were buying and selling because they had to.
Definitely.
They were moving up.
Yeah.
They saw opportunities. So it just goes up the, whether it goes up the chain or down, down, doesn't matter. So my opinion is that even if there is a recession or if there is an adjustment, you could still find value and good investments.
Hold on to it for an extra year.
Yeah. Plus, if you're a homeowner, if you have that mindset of a homeowner, also you might be there for 10 years, and so I would be entirely comfortable if I found a home with a family or a significant other, and I it had no intention of making a quick buck. I'm good. I've got my home and that's it.
I think that's also an interesting trend as well, is that homeowners now are very used to, it's almost like the asset they're buying, they're almost like, oh, well, it needs to make like 5% a year kind of thing. Yeah. Do you know what I mean? They're so used to it now that it's become like, oh, well, I'm buying a house. And like someone said that to me the other day and I was like, well, they were like, oh, well, what happens if I buy it and then the economy is not great for a couple of years? And I was like, well, you could just live in it.
Yeah.
Because that's actually really why you're buying it.
Yeah.
It's almost, they look at it as like, I'm buying my dream home or the home that I'm going to live in as well as this asset thing.
Yeah.
And it's almost like, if that's not there, then this doesn't matter. Kind of, which is quite odd, because I'm like, you are buying a house because you want to live in it. You do realise that. It's not like you're taking out stock or, which is kind of a crazy one. So that's going to be, I think that'll be, because also the other thing that you were saying with LA there, which I find really fascinating, is it is almost like 8 cities next to each other. Because whenever I would sell property in London, the centre of London is most expensive, and then it almost ripples out from there.
Yeah.
And LA is not like that, because when my wife first moved to LA in 2009, she moved downtown. And downtown LA, I came from London, and I'm like, oh, it's the middle of London.
Yeah.
Like, it's going to be the middle of LA. It's going to be the same. It's going to be where everyone is, and everyone goes there for the night time. And then I was there in 2009. I'm like, 6 o'clock, and everyone's it's like a concrete jungle with no one here.
Right.
And so it does become a bit of an odd one where, you buy in that one market that has, is going to emerge. It's not like LA is just one market.
Right.
It's like, okay, well, you bought in Beverly Hills when the prices had done 10% in Beverly Hills over the last year, as opposed to you bought in Hancock Park where prices were a bit lower and actually hadn't been going up, and now they're really...
Yeah.
So that's where I find it quite difficult sometimes to...
And there's always those, single properties that are kind of trophy properties,
Yeah.
or something that's been redone and it's done tastefully,
Yeah.
and it's really has a lot of appeal.
Yeah.
And so a buyer, LA is an interesting market because people will put money into, they almost don't care about the neighborhood.
Yeah.
They're buying the house
Yeah.
for the house, so that you have those types of buyers too.
Definitely.
Especially
with like the Hollywood history ones you get here as well.
Yeah.
This was this person's old house.
Yeah.
And I love that.
Yeah.
Because actually.
So that's a whole. LA has a lot of that in
Yeah.
every area. So
definitely.
Yeah.
And you're right, because that's the other thing that's quite weird, is that it's almost like different areas have different reasons people have moved there. It's like you get that kind of, the kind of Hancock Park area's got a lot of like music industry people, and then you've got Venice, which is kind of a bit more of your like artistic-y thing, but they've had Snapchat move in. You've got Beverly Hills, where it's massive estate lots, and it's so. But that's actually was when I first moved from London. I was like, what I'm going to miss is the history kind of side of it, because LA is obviously an oldish city, but it's 100, 150 years old, really, most of it. Whereas London's like a couple of thousand years old.
Yeah.
So I'd be walking around some properties and it's like 400 years old, and I was like, it's going to be weird when I'm in LA and they just knock everything down, rebuild it. There's not as much of that. But what I've actually been drawn to massively is that whole side of it, because you get, this musician lived here for this many years. Oh, this person built this house, and because of the Hollywood and kind of, because it's a global thing.
Yeah.
Everyone across the world knows actors' names and whatever it is. Like that was, it's almost weird. I'd love to actually maybe do a study on that. Is what does a actor or a famous person's name do to the price of a property?
Right.
Yeah. If that person lived here, does that add an extra 10% or not? Or because that is.
I'm sure there's some appeal. I guess it's different for everyone. But
definitely.
I mean, just take a look at how a property's marketed.
Yeah.
They're almost always led with that.
They are. You're right.
Whatever it may be.
Unless the client is the current, person with that name, and then for some reason they're like, I want my privacy kind of thing. Then they'll.
Then there's celebrity. Then it'll say celebrity-owned house for sale. Things like that.
Yeah, I did one on Tuesday actually. That was Brad Pitt and Jennifer Aniston.
Oh, really?
House.
Yeah.
And so I'm walking around it, and as soon as I walk in the door, the agent's like, "Oh, well, Brad and Jennifer were here."
Yeah.
And like obviously they want you to be aware of that because then there's some kind of. But then also, I don't know if that one's going to have that much history as much.
Right.
As, Actually, there was one that I really liked. I went to one of the old school. I think it was on the market at the time for about 110 million. It was a massive estate, incredibly dated, back from like the 40s, where it was kind of the heyday of Hollywood. But it actually had in one of the closets had a secret door that led downstairs to what was a bar during Prohibition. And so obviously this person had built like a bar, and in the inside of the door had Charlie Chaplin's signature on it.
Oh, wow.
Yeah, so I was wondering, I was like, this is like...
That's classic.
I'd buy the house if I had the money just for that kind of thing. Yeah, because you got the extra. Okay, so what is it like being a mortgage broker day to day? Because presumably now you're quite far in your career, you're at that level where actually you're kind of overseeing people more than doing the actual transactions as much.
Yeah, I try to.
Yeah.
Yeah, I try not to be in the transaction at all. But I am. I have to be.
You're kind of, because you're the kind of, you're responsible for it, but the actual kind of actions, you're kind of making sure that these people are doing. Yeah.
It's kind of like where I spend a lot of time at lead generation.
Yeah.
Follow-ups. Then current clients, current escrows.
Yeah.
And I have to, I'm a little OCD in the sense I like to. I'm usually in the file probably more than I should be, because I just, I want it to be done.
Yeah.
You know what I mean?
Well,
everything's a sense of urgency with me. It probably drives my, the team I work with, that probably drives them crazy.
Yeah.
But
micromanaging them. So.
Well, yeah, I don't. Yeah, but I just kind of like, on one hand, I'm definitely not a. I've always said that I don't like looking at conditions and doing the paperwork. That's not my strong suit.
No.
That's not where I like to spend my time.
Yeah.
But I do like, but I'm cursed because I just want it to be done so badly that I'll have to go through and look at it all to see if there's anything. But if I feel like a file's been handled okay and time-wise we're doing fine, I usually just try to let it go. And I keep in contact with the client.
Have you got better at that?
Yeah.
Because I think when you first probably are going from doing literally taking the transaction through the entire process to then you do, that must be like a really difficult.
Yeah, well, it's funny because one of the very first loans I got like the loan approval and these conditions. And of course, I had no idea what I was doing, so I called up my processor and I was like, "Hey, can we go over these conditions?"
Yeah.
And she was like, "Okay." So I started going through one by one. This, like what, and she was like, "Are we gonna do this on every loan?" And I'm like, "I don't know. Are we? Like, do we?"
It's the first time handing it off to you, so.
But times, I've come a long way since then.
Yeah.
And I don't do that much. But sometimes I won't even look at an approval. Okay. But like really, like the best thing about my job is the connection.
Yeah.
With building relationships and having those relationships. And I think I'm at my best if I'm not at my desk, having to sort through conditions. Although sometimes I need to step in and handle the condition with the client, because it can still get pretty tiresome on the client side, and they're just over it, So I have to help them through that process.
So your Monday, you wake up in the morning, you've got those kind of clients or connections and relationships that you're kind of meeting for a breakfast meeting. Is that kind of where it is? You're popping into the office a couple of times a day?
Yeah. So on the phone, making phone calls, follow-ups, trying to see people as much as I can. Like, how I met you, I think I, reached out several times to try to get a face-to-face.
Definitely.
And that's what it is. It's like the actual face-to-face.
Yeah.
Or the first contact, the follow-up, tracking it.
Have you ever felt yourself like burnt out with that slightly? Because I've had like, not that I have been burnt out, but I've definitely had those feelings sometimes. And I think we're doing it probably in a bit of a different way, where we're like following up with leads.
Yeah.
You know what I mean? Where it's someone you've never met, you've got no idea apart from this name on the sheet.
Right.
But have you ever found yourself being a bit like, oh my God, I've got to literally just call 50 people today? Or what,
yeah, for sure.
Yeah.
I think it would be everyone's number one objection to doing the work is the work.
Yeah.
Picking up the phone, picking up a 50-pound phone, that's the hardest part, I think, for a lot of people. But for me, it is too, know. But, once the momentum starts to go and, things start to happen, it works. But I get burnt out. And every now and then I'll have to take a break or, do a staycation or go somewhere. But, it's all like, if we work in an industry where if we want a pay raise, we got to make more phone calls, or we got to close more deals, or we have to do things like that.
There's no just you impress that boss, and then that boss gives you the the way up in your thing. You're only done on your transactional.
Yeah. So, we're in that business. I'm in that realm, and so I have to remember that.
So if there are people out there thinking, from what you've just said, Tony, I'd actually like to explore being a mortgage broker.
Yeah.
You have to be one of those people that's like self-motivated, would you say?
Yeah, for sure. And, just being good at building relationships.
Yeah.
Because as a mortgage broker, you got to know the market. I mean, the industry.
Yeah.
And know your rates and programs in the matrix with lenders, so you can identify opportunities, know what you're doing.
Yeah.
But I think a lot of it is, networking and getting the meetings with the realtors and business managers, CPAs, attorneys.
Yeah.
Having that lined up. So if you really are brand new, that's the best ways to work with another mortgage
broker to kind of
broker on their team, even if you have to start with chasing conditions, and all that, because that's how you'll learn the business, and then from there you'll just grow.
Yeah, because otherwise, I suppose if you try to do it yourself, kind of thing, you're trying to learn and actually see the day to day of and work out what you're trying to do. Plus, you're having to try and be face to face as many people.
Yeah, and the barrier to entry in the mortgage industry has really become more difficult.
Yeah.
Before it wasn't. Before you just need a real estate license, and almost anyone could get a job as long as someone's willing to hire them. Now you have your NMLS license. You got to pass that test. It's a lot more rigorous than it was before. And then also, lenders are really protective because they can't. You don't want to put someone in a precarious position, but you can't present faulty loans, or no one wants to bring that to the table. So the loan officers are held to higher accountability and higher standards.
Yeah. Okay.
So that's another thing. But again, it's does not to sound discouraging, because it's really, the barrier to entry isn't that great. I mean, you get your license, you work for someone, you learn the business.
Yeah.
You get up early, you stay late, you do what you have to do. You can be successful at anything,
Have you ever seen a mortgage broker who's like not good at that face-to-face thing, but has been successful?
Yeah, actually, I know guys who really do great in front of their computers, making phone calls, or just emails.
They like to be in their little zone, but actually, like, the volume of work they can put out is massive.
Sometimes that's just their
Okay.
And it works.
Yeah.
It can work for some people. It's funny, like, a lot of times I would prefer to meet with people, borrowers, prospects, agents, but almost 80% of the time, 90% of the time, no one can meet or has time or wants to. So a lot of times they're quite content with just, hey, I know you're there, I'll give you a call, rather than me saying, let's go have a lunch or something. And then I'm savvy. I understand that, and
people are like compressing their time down. They need to get as much as they can.
Yeah. So a lot of times it's just better. And I find that it's really more difficult to meet with borrowers. They're really just more interested in getting the loan approved.
Yeah.
But I do like to meet with them, if possible.
Yeah.
Yeah.
Because I suppose, during that process, they're excited about buying a house, because obviously they're thinking like, oh, I'm going to be in this house. The mortgage side of it, generally, I find for most of our buyers is not. They're not that. They know they have to do it.
Yeah.
But it's not like, when I have the conversation with them, they're like, oh, when can I move in?
Yeah.
And, oh, I'm going to do this with that room and this. And I suppose when you're having those conversations, it's more like, congratulations, we got the loan approved.
Yeah.
But they're a bit like, okay, well, I was expecting that kind of thing.
Well, and it's also hard. Sometimes they just don't want to deal with the paperwork.
Yeah.
And that's really probably one of the biggest obstacles to getting a loan done.
Yeah.
Yeah.
It is weird, isn't it? How people sit down and they don't like signing things or like reading through. I mean, how many of your clients, when you're dealing with them, do you think actually read through the entire thing of like point 1A?
Like, I did a loan for an attorney recently, and they're the only ones that will ever read through anything. Yeah. So nobody else does.
Because they don't want to put their name on something.
Absolutely. It's just like clockwork. I got an email. He wanted to like add a paragraph to one of the disclosures. Yeah. I was like, put it in.
In fact, that's hilarious actually, because we did a transaction in San Francisco last year actually. It's for a client who bought a really beautiful property there. The seller was a lawyer. And so they were moving to another state. And so literally the agent representing the seller was freaking out. So he was like, I've never had anyone request this. But what he is wanting is an addendum saying that if for any reason your client sues him for some reason, there's an issue with the property they didn't disclose or anything like that any of that legal work has to go on in, I think it was Wisconsin. That's where they were moving to.
Wow.
And I was like, I literally told my client, I'm like, look, I don't think this is like good, but to be honest, like they're turning around and just saying like, we're not going to agree this offer unless you do this. And I'm like, the worst comes to the worst, you're going to have to get on a plane and go to Wisconsin to like go to trial if that happens. And they were like, I mean, it's just a fucking nightmare.
Yeah.
But it was the one lawyer who was like, I don't want to be pulled back to San Francisco when something goes on.
And the other thing is that's a real painstaking process is whenever someone gets a loan, refinance or purchase. Yeah. The lenders, it's kind of absurd in a way, because if you're a lender, it's like, they look at the last 2 months of bank statements, for example, and they'll look at basically the line item. If there's any, large deposits that are coming in, they want to make sure they source that and make sure that's coming from an acceptable source. Yeah. But
it's not drug money or
exactly. I mean, that's it. In a lot of respects, it's for fraud protection. Yeah. Absolutely, like illegal money. Yeah. But things that are legit. But to a homeowner, to a buyer who's basically who's innocent, just a person. They'll look at everything, and they'll if a transaction takes 3 months, that means they look at 3 months bank statements. They'll look at every and that's the worst part, because now it's like someone has to explain certain things all the time. Like, so and that's what's unfortunate. That like they'll look at a deposit, like where did this $5,000 deposit come from, and you have to explain it. So we have to get a copy of the check, of the deposit, and explain where it came from, and that has to occur quite often.
So almost you have someone looking over your shoulder when you're going through the transaction.
But it's only for the month. It's only for those months that you're buying the house. Like so, if it makes sense, but it doesn't. Like they should. Why not look at 3 years? Like if they want to like really go for illegal activity.
Well, and the other side as well, I suppose, is that because we always tell our clients, like when you get into escrow, don't just be like, oh well, I've got my offer agreed, I'm in escrow, and go and buy a new car.
Oh yeah.
Because like it's going to affect your credit score if you're taking out because that's another thing that's quite weird, isn't it? It's almost like you need to be coached during like a couple of month period. Absolutely. To like just live a very boring, straightforward life.
It's true, and it's really also one of the biggest benefits to getting pre-approved from the very beginning.
Yeah, absolutely.
Just if you're talking about buying a property and you're serious, then there's no other place to start than getting pre-approved.
Yeah.
And at least having a conversation, but running credit is really necessary in most cases.
Okay, no, I like that a lot because that's what we always tell our clients. But a lot of them, again, it goes back to that thing where they're excited to go and do the showings, but actually going through filling out the paperwork and getting the pre-approval. I mean, there's been points where I'm like, look, we're not doing any more showings unless you go and get pre-approved because it's a waste of my time, it's your time. Actually, the reason I normally give my buyers, which is actually completely why we always say to them, please get pre-approved before we do showings, is because the amount of times when it's a good property and it's just hit the market and you go and have a look at it and you want to buy it, there's going to be a couple of other people who want the same thing.
Yeah.
And so if they're putting their offers in with a pre-approval and you're spending like 2-3 days getting word back that you're pre-approved, you lose the property.
Yeah.
And so it's almost like putting all of your cards in a row in a position where you can just pull the trigger,
right?
As opposed to being like, oh, I do like that one actually. Now what do I need to do? Someone else got it.
Yeah.
It's a weird one.
Absolutely, and also just to know, even if it's a 6-month plan, to know, because you're right. You don't want to charge up cards before you close escrow.
Yeah.
You don't want to buy a new car before you close escrow, or lease a new car, or obviously you don't want to change jobs, but these are things that people would really take for granted, and they get pre-approved, and things might change.
Yeah.
So it's we do our best to have these conversations up front, so make sure that there's no financial changes between now and when they open escrow on something.
That makes me think we need to create a video now, Tony, of you just sitting there being like, right, you've got into escrow, congratulations.
Yeah.
Don't do this. This.
Yeah.
Actually, a lot of people are like, they'll ask the questions occasionally, but no one has like let's go and actually do that.
And also there's credit strategy, so if their FICO score is a little low and they want to get it up, then we can discuss how to do that. And
it's always like you take out a credit card, put like a very small charge on it or something.
Well,
make sure it's like paid off ahead of time and things.
I mean that helps over time.
Okay.
But like if they have a credit card and it carries a balance, the $5,000 limit, and they carry a $4,500 balance, all they got to do is pay it down to about 10 or 20% of the $5,000,
and that'll kind of
and the score could jump up. And
really,
we have access to it's called a what if simulator, so I could play around with anyone's credit. So as soon as I pull it, I can say if you paid this down or did this, did that, your score will go up to this.
Wow. Yeah. And at the moment, is it kind of 750s where you're kind of, that's the gateway to you're open to every kind of mortgage at that point?
Oh, no. I mean, you could do, technically there are lenders who don't have a minimum credit score.
Yeah.
Or maybe it's a 620 minimum or 680. Each tier provides probably a better interest rate or requires more down or certain other restrictions.
Yeah.
But oftentimes, if someone has even if I tell you I could do a loan with a 550 credit score, even if I were to say that, which I really don't even go around talking about it much, because if someone has a 580 credit score, and there's a lender who will do a loan on a 580 credit score, chances are they have some things going on with their credit that need to be addressed. So it's not based on just the FICO score or the credit score. It's based on what's happening, what's going on. They might have 10 open collections.
Yeah.
And we may have to address each one of those collections. They would have to pay the collection, close it, so before we can do a loan, regardless of the credit score.
Okay.
So it's a real tricky thing to lead with a credit score.
Yeah.
Because it's actually, I mean, even if someone has a 720 credit score and they have a judgment, it's possible.
Yeah. Okay.
And so we can't, even this credit score alone won't get them the loan. They have to address certain items that are on the credit.
So if someone out there is listening right now and they're thinking, right, if I want to buy a house in 3 years, what should be the target for them to kind of hit with their credit score if they're checking on it?
If they really want the very best, and
options.
they could do a 740 plus. But I mean, even if they had a 700 credit score, compared to a 740, let's just be general with it on a macro level. The interest rate could be an eighth less or an eighth more, or maybe it may not. Just depends. An eighth or a quarter more.
Okay.
Given on that day.
So that's crazy. So, yeah, that's really interesting. What about trends with that? Have you seen lenders who have actually, are reducing the height of the credit score needed to, have certain products?
In some cases, yeah, that does. Like I have lenders. I think their threshold 680. I mean, anything above a 680,
it's going to be most.
It's the same. Available. It's the same.
Okay.
Whether it's an 800 or a 6, it doesn't matter what your score is.
Okay.
They won't. But most Fannie, like most of the conventional conforming, FHA, any of those loans, the matrix exists and they have credit score ranges. So if your score is between 600 and 620, there's this much of an add-on. 621 to 650, there's this much of an add-on, and it's like that. Okay. And that's almost all. That's almost for all lenders.
Okay.
But they can adjust it. So, they can reduce the credit score, and lower the hit.
Okay.
And that's possible.
Okay, I see. Yeah. What about the trend that we kind of, because there's a lot of people that say, when you pull the credit score, it actually affects your credit score slightly when you check on it.
Yeah.
Do you, because I hear a little bit mixed on that. People are like, oh, don't worry, we can check your credit score and it's not really going to affect it. But it is a kind of situation, I think, when you're checking it quite a few times in a small time period.
Yeah, it works like this. Generally, if a mortgage company pulls credit, the inquiry shows up, but it won't affect the credit score for 30 to 45 days. So it gives the borrower an opportunity to shop for a loan without their credit score being impacted. So if someone were to apply to 5 different lenders in 1 week, their credit score won't go down because of that.
Okay.
Like right during that time period.
But after that time?
Perhaps, yeah, it can. But another thing to consider is the factor that goes into each credit score has a bunch of factors that affect the score.
Yeah.
Good credit history, the extent of the credit, how many credit cards, their debt, things, a lot of factors. Recent late payments. If mortgage companies can have a lesser factor on the credit score.
Yeah.
So even if when the inquiry hits their credit, it might not even impact their score.
Okay.
I mean, it could be a point or two. The factor is a small amount.
Okay.
But if they were to apply to 5 different credit cards or 5 different car loans, direct sources of money that are department store cards, things like that will have an immediate impact, and the weight for those are greater, so it could have a greater impact on the credit score.
I see. Yeah, which is kind of crazy. Okay, we'll be chatting actually for almost an hour and 20 minutes.
No way.
Yeah, it's like time just goes, isn't it, when we're like
That's
chatting.
awesome. Yeah.
But actually, it's probably a good time to wrap it up, because actually I think we could just be sat here chatting for the next 4 hours. So Tony, if anyone's out there and they're thinking, they want to actually get some more information about potentially getting a loan, getting a mortgage, is that the kind of thing you have? Is that initial conversation with a lot of people who are buyers?
Yeah, I love talking to, absolutely.
And LA is kind of your main market? You do California?
I do California, yeah.
So you can kind of do anything in that area?
Yeah.
So if anyone out there wanted to contact you, they can find you on LinkedIn. I know Tony Svoboda.
Yeah.
How do I say it?
Svoboda.
Svoboda. Okay,
yeah.
I'm going to get that really good. Email. Have you got an email they can contact you on?
Yeah, it's T and then my last name, TSVOBODA at rpm-mtg.com.
So RPM kind of mortgage. But
yeah, rpm-mtg.com.
Okay, awesome. So guys, if anyone is out there, if you have questions about potentially getting a loan, what are the kind of price points that you kind of specialize in or would be happy kind of working
Well,
as well?
as I mentioned, my average loan size is roughly 700,000.
Yeah.
So with that, I'm usually doing well. It's just with that I get all kinds. I do FHA, but most of my loans are 10 to 20% down.
Yeah.
In the jumbo category.
Okay.
And a lot of outside the box. I like the difficult loans. I'd say
Working out the kind of
because any lender can do the same loan as a big bank.
Yeah.
Anyone can do it.
Yeah.
But I have specialty loans, and I have loans that are outside the box
and structure them in a way where it's actually going to make that available for someone
Yeah.
as opposed to that's really cool. So guys, I want to say thank you so much to Tony for joining us. It's been great to chat with you.
Thanks.
And so if anyone out there has any questions, reach out to me on email. And then you're on social. You're doing some more social now, are you?
Yeah, like I'm gonna I listen to Gary Vee a lot.
Oh yeah,
so
you love Gary Vee.
I've got to get on that. But I do post a lot and do some things on social media. I have a Facebook RPM page.
Yep.
It's off of my Facebook page. Friend me or just look me up on Facebook. I do have an Instagram. It's my name, Tony Svoboda 07 on Instagram, and I'll be posting more videos and updates on the Instagram and Facebook. So check me out.
Awesome.
Yeah.
Well, thank you so much, Tony. Thank you so much to everyone for listening. We'd love your feedback as well. So leave any comments. Let us know if you have any questions, and we'll try and follow up with them. But have a great day wherever you are in the world. And I think we all know a lot more about mortgages right now.
Cool. Thanks.
Awesome.